Hi there and welcome to this video which is going to explain to you how to trade expected interest rate moves. Now sometimes a central bank will let you know in advance that it's going to raise the interest rates, and a good example recently has been the US dollar Turkish lira pair. Now what happened is the Turkish central bank has said that they're going to try and get hold of the weakening Turkish lira by increasing interest rates, and they announced it about sort of 7 or 10 days before the interest rates are actually going to be increased. And so the market was expecting a reaction from the central bank, and this is how the price action played out in anticipation of those market moves. The Turkish lira was bought, which is bearish US dollar Turkish lira. Price was contained by the 200 moving averages because obviously market participants knew that the central bank was going to come in and on its meeting on the 13th of September had already said it's going to raise interest rates. So the way to play it is you can enter the market literally just before, 5 minutes before the interest rate announcement is going to come, because you know it's coming. So in this instance, if you just waited 5 minutes beforehand, you could have entered the market around here. Now, this isn't the best pair to trade, US dollar Turkish lira, because of the wide spread you get. But imagine, it was a different pair, or, you just used, you've leveraged right down. You might be using negative leverage. You could have entered right here, had a big wide stop on, and then when the interest rate increased, now, as it happened, the Turkish central bank surprised markets. A 3 percentage point interest rate rise was expected, which is still massive. However, they exceeded it, and I think it was about 6.75%, something like that. So that is a good invitation and a good example of trading interest rates when they're expected. So just wait 5 minutes before, enter, nice wide stop, so don't use a lot of leverage. Then as soon as the spike is down, just exit on the spike. In this instance, you might have held because it was such an extreme reaction. But as a general rule, as soon as you've got that happening, you exit and you've just taken the trade out on the spike. So there you go, guys. That's a way of trading expected interest rate moves.